Let's see, we've got a great call put together for you guys today. This webinar is all about financial systems for dental practice growth. We're going to talk to you today a lot about how to increase your practice EBITDA, but also some of the great systems and solutions that our friends over here at DSO CFO, Austin Moffett and T. Hughes, the systems they use to help dental practices to grow their financial systems. So that being said, just a brief reminder for you guys, we are eAssist. eAssist is here to optimize your revenue cycle. And we are here to actually help you collect what is rightfully owed to you from insurance companies or your patients as part of our billing process. And we've collected more than $8.15 billion to date from insurance companies. We have a lot of services that we offer, but some of our primary ones that we want to make sure you guys are aware of is, of course, our dental insurance billing, our patient portion billing, insurance verification, our dental bookkeeping and reconciliation, credentialing and fee schedule updates, and full schedule patient recall and recare. So we have a lot of options here to help make your practice as profitable as possible. I never take a ton of time on this slide, but we've won a lot of awesome awards. We have a lot of great partners. We feel really lucky to be able to serve the dental industry the way that we do. That being said, I'm going to hand this over to T and let T introduce himself real quick and let you guys know who he is and what he's about.
Yeah, thank you for having us. And I just wanted to give a brief introduction in the context of what we're talking about today. So I've owned DSOs, and one of the issues that we found often when we were in growth mode was trying to figure out where we were going to get the capital, how we were going to engage that capital, and how we were going to do that effectively. And finding a partner that could really help us and guide us in areas where we felt weak in that financial realm was always difficult. And through kind of that school of hard knocks, we were able to figure out some systems and protocols that really helped us to get to a point where we had developed a system and that could really help others. And that was the impetus of DSO CFO, is being able to take our learning and our background and put that together into something where we were very passionate about helping businesses to grow and to get to that next level.
Thanks so much, T. That's awesome. Now let's jump over to your colleague here, your friend, Austin Moffett. Austin, give us a little bit of rundown about you.
Yeah, sure. No, thank you. To echo T, we're super grateful. I'm the accounting and finance head, if you will, of DSO CFO. I'm the one that interacts with our clients from a high level basis and really also getting into the weeds when it comes to financial analysis, forecasting, budget creation, if you will, really on the growth factors of the business, valuations, acquisitions, all that stuff. So that's kind of my role within the company. I've been doing accounting and finance reporting for about 10 years, but specifically working in dental for about the last 6 or 7 years, almost from a financial analyst and CFO role, CFO role. So it's been really fun. In eAssist, it's been a very perfect symbiotic relationship, and we're very excited to what we've got in store today.
Yeah, I can't echo those sentiments enough. eAssist, as you guys know, most of you on the call are familiar with eAssist. You're customers of eAssist. You've worked with us for a while, and we are just thrilled to be launching this partnership with DSO CFO. And they're just a great company, great group of people with great similar values to what eAssist stands for, which is really here to serve and give peace of mind to dentists. So you guys are thrilled to have you. You guys are going to be a great audience today. You're going to love hearing from these two. And that being said, I'm going to let you guys take it away. T, you want to kick us off on this first slide?
Yeah. So really what we're about at DSO CFO is this having those, like the title says, these transparent financial solutions. We want to make sure that we're putting things in place that are going to make it so strategic decisions can be made more effectively. So it's putting that financial lens. So whether it's expanding the office, adding to the hygiene department, or whatever it might be, are all these things, trends from the industry and things that we've accumulated that can help put that lens and make that lens adjust to the business to make sure that that is in line with the vision for the business. So whether we're looking at single practitioner or multi-practice, or people that are looking to go to multi-practice, we can take those financials and make them work for you guys and work for the practice to make sure that the business is in line with those things. So I don't know if you had something specific on that, but
no, I mean, I think, I mean, we'll get right into it. I think, I mean, it really starts from your financials. Sarah, would you mind just tapping the next page and we can just get right into it? I think.
Absolutely. And just before we dive in, just to give everyone a quick overview again, I know a few people have joined the call before we had mentioned this. Just so you know, we are going to send everyone a copy of the slides as well as the recording, and we are going to have a couple Q&A sessions. So drop those questions into the Q&A bubbles at the bottom of your Zoom screen. And then before we kick off, I'm just going to run through a few of the things you're going to cover today, right? So just high level, so you guys know what to pay attention to. Our goal is always that although we may give you a lot of information in a webinar, we hope you can find one nugget, right? So these are a few things we're going to cover, but find one nugget. If you take one nugget away from this that you can implement in your practice, it's going to be well worth 1 hour of your time for the growth that your practice will see. So of course, the first item here in the corner is identify the 7 financial systems for dental practice growth. And if you're ready for a fractional CFO, right? That's important to know when's the right time. Number 2, understand benchmarks, budgets, and KPIs and why they are important to your financial health. And number 3, optimizing your revenue cycle management and improving your cash flow by adding extra eyes to your financials, which of course flows really nicely into the dental billing most of you guys are probably already in within eAssist. That being said, let's go ahead and jump on into a poll. Is that good with you guys?
yes.
Let's do it.
All right, our very first poll here. The first question we want to ask you guys, you'll see your poll jump up on your screen. So you guys just be ready to answer it. The question we're asking is, what is your next big financial decision for your dental practice? All right, I've got that live now. You guys go ahead and jump in there and take a vote. We've got a few options in here: adding an associate, adding a hygienist, adding a location, adding an operatory, updating or purchasing new equipment. If what you're thinking isn't one of those things, try to pick the one that's closest. This is going to help us make sure that we cater to what you guys want to cover and what you guys are interested in following this call. So really important that you guys jump in there. It looks like we've got almost about 50% of the folks on the call who have already participated. So let's leave this up for just a few more seconds. If you guys see that poll screen pop up, go ahead and jump on in there. Again, we're looking to find out what are your next big financial decisions for your dental practice. Awesome. Okay, we're right at about almost 75% of the folks have voted. If you're one of the holdouts, jump on in right now. This will be really helpful for us for the webinar today. Okay, that being said, let's go ahead and end this poll. I'm going to go ahead and share the results with you guys too. I'm going to broadcast that. You guys should see the answers there on the screen. So about 42% of you guys said adding an associate. That's a pretty big chunk of the group. Next up, looks like 35% said updating or purchasing new equipment. Of course, both those things are big financial commitments, and you got to make sure you're prepared for them. Next up, 31% is adding an additional location, a new practice location. 25% said adding a hygienist, and then 15% said adding an operatory. That's awesome. Okay, thank you guys so much. Now, before we move into the fun, meaty content, we've got one more poll we want to ask you. Super important to follow up to that last one. How confident are you? How financially ready are you to move forward with that decision you just said? This is a quick yes or no. You feel like you're financially ready? If you're going to add that associate, if you're going to add that operatory, do you feel 100% confident that you're financially ready to make that next step? Awesome. All right, we got about 63% of the call who has voted. Let's go ahead and get a few more seconds in here. We're just going to give you about 10 more seconds before we close this one down. All right, 3, 2, 1, and let's end that poll and share those results. You guys will see that 53% of you on the call don't feel financially ready for that. 47% of you do, which is amazing. That's great. I hope that those 47% are still going to learn something new, and hopefully we can still help you find even more financial readiness for making those big investments for your practice. But the 53% of you, I think you're going to have a lot that you're going to learn from this call today. We're really excited to share that with you. And I hope that at the end of this call, you guys feel a little bit more ready to make that decision. All right, that is it for our polls. So I'm going to hand this back over to you guys. Let's jump right on in on item number 1.
Awesome. Thanks, Sarah. That was actually really cool. That's very enlightening to see. Just super quickly, if we could just touch on some of those items that I guess the top 3 items. T, did you want to just hit on that real fast?
Well, I was just going to say something that's not necessarily right on the agenda that I think we were going after today, but I just want to say from how important it is to make sure that we are, as we're going through these big financial decisions or things that are happening within the business, to seek out a community. Like the fact that we're able to do that and see these kind of responses just right away on stuff that's probably keeping a lot of people up at night and making these major financial decisions, how important it is to have community or someone to bounce these things off. And that could be another dentist in town, that could be a study group. There are just a lot of ways that could happen. And so that doesn't have anything to do necessarily with what we're talking about today, but if you guys are stressed about these decisions and we're hoping to present some ideas to make it less stressful or opportunities to make it less stressful, but that community aspect, it was very powerful to me as we're watching this, that there is a lot of power in the community and being able to bounce ideas off someone that you respect and can get some information and you can give some advice to back and forth. Just kind of as a side note.
Cool. Awesome. So we're going to kind of take this, our approach here in a 2-tier. The first tier you'll see here is almost the foundational when it comes to bookkeeping, really, because that's where your data comes from. Your data comes from your books, your financials. And one of the things that we encourage and that we talk about often is having dental specific bookkeeping and accounting. Now, why is that important? Well, that's important because as a dentist, you want to see some of those key accounts that you're spending, specifically, outside of revenue. Of course, that's number one, but on some of your expense management items, like for example, supplies, labs, payroll, marketing, maybe computer expenses or reoccurring subscriptions is a big thing for you, right? But you want to be able to have your financials customized in a way that you as a dentist understand what's really taking place in my practice from a month-over-month basis. And so, there's a ton of excellent firms out there, dental or non-dental, but what we do see is those non-dental related accounting firms or bookkeepers is at the top, expense line. Maybe it's office expense, maybe it's like rental expense or what, maybe interest or whatever. But and then maybe there's supplies in the middle and then lab fees at the bottom, right? It would be nice from a dentist perspective to see your clinical expenses almost lumped together, almost not like clinical expenses one line item, but a dental supplies, a lab supplies. Maybe you have perio expenses, maybe you have ortho expenses that you want to track, but you want to know what you're seeing from a clinical expense related item.
I was just going to say the chart of accounts, what we see, your financial statements, especially when you're looking at the P&L, what's happening is you're seeing your P&L and you're saying, great, the P&L is taken care of. That should not be what's happening. You should be looking at your P&L and there's a story that's being told with every P&L. Correct. And as you're looking through your P&L, if it's not, oftentimes what we're seeing for accounting firms or bookkeepers that aren't familiar with the dental industry, the miscategorization is pretty prevalent. And so that categorization is important because if you want a real story of what's happening with your financials, it's going to be difficult to do that if your chart of accounts, number one, isn't detailed out correctly. And I don't know whether we need to define some of these things, but as far as the chart of accounts are concerned, that's how you have specified out what expenses go into what categorization. And that's critical to have because when you have a chart of accounts that's telling you where everything needs to go, then it's easier for your bookkeeper or your accountant to follow that map. And then now when you're getting your P&L, okay, great, my P&L is telling me exactly where the expenses are. And then you can identify opportunities and issues. And that's where you can go through and say, hey, we're doing really well here, but why is this presenting something that's a problem? And we'll go through that a little bit more in the P&L on how we best track and identify those problems and how you guys can incorporate some of those things to kind of move that.
Right.
So you.
Yeah, we'll do. I think we're good. Yeah, I think you're good for the next one, Sarah. Awesome. And then piggybacking off of the first one, it's important that you understand your financials. So like T was saying, oftentimes things are miscategorized, right? Maybe you have a lab supply that's sitting in lab, or maybe you have an ortho expense that's sitting in lab, or those are some of the more common things that we see. But maybe you're really tracking your monthly expenses and supplies and lab fees and what other clinical expenses that you may be incurring, right? Maybe you have a budget in your office manager or someone at your front desk or whatever, maybe yourself are tracking. And it's one thing to see it. It's another thing to drill into it and say, wait a second, that's a lab fee. Wait a second, that's ortho. Hold on. Yeah, I know this says I went to Walgreens, but really this is like an office expense, right? Or whatever, right? So it's important to have those transparent financials. And for us, it's simplicity and it's transparency. I mean, that is honestly our mantra when it comes to financials, because look, we realize that you guys are dentists. You guys didn't necessarily go to accounting school or finance school, or, so we take it upon ourselves to make it as easy as possible for dentists to understand what's really taking place in your practice. And if you can look at your P&L for 5 minutes, and that's maybe even 3 minutes, and understand what's properly happening, and you're confident in the data that you're seeing, then that makes all the difference.
Yeah, and it's not just miscategorization. Oftentimes we'll find a chart of accounts, or we'll look at a P&L. Someone will send us their most recent P&L, and we'll look through the P&L, and you'll have dental supplies, you'll have your like standard expenses, and then down at the bottom of the P&L, they'll have several things that have these like curious or mysterious categorization titles. And then when we start digging and we start asking questions, like that's the last thing you as an owner or a practitioner wants to be doing, is getting to the bottom of your financials and spending all of your time on the stuff that is like ask the dentist, or we see that all the time,
miscellaneous.
Where it's just like miscellaneous or just or not even miscellaneous, it's like dental supply and then specific to whatever the bookkeeper was interpreting because they didn't get a response in time before they pushed out the P&L.
Right.
And so one thing I would challenge everybody is when you're doing your chart of accounts, right? And you might think I've already got a P&L and the P&L is fine, but go back through your P&L and make sure your expenses make sense to you, right? Like if you're looking through the P&L and you're like, well, this is just what the bookkeeper does, like go back to them and push back on them and say, hey, I need this to make sense to me, whether that's sitting down and taking all the clinical expenses and putting them into a section and categorizing that, or making sure that just whatever is going to make the most sense for you so that you can actually, you can encapsulate those expenses in digestible pieces. That is really, to us, that's what makes sense to call it simple and transparent.
Right. You're allowed to customize your financials in a way that makes sense to you. And that's specific to the P&L. Balance sheet is a little bit different. But the P&L, you're allowed to view that in a way that makes sense to you. I think we're good, Sarah. We can probably go to the next 2 slides, I think.
Great. All right.
Okay. Consolidated financials. Now, this is a really unique topic, and I'm going to start this topic from a recent conversation that we had with, I won't name the bank, but it is the largest bank playing in dental right now. And they said, we will not look at, for those practices or groups that are looking to do deals with this specific bank, right? They said, we will not look at practices if they do not have consolidated financials, right? So I thought that was really unique. That to me shows that banks are starting to understand a little bit more about dental, some more than others, but they're starting to understand a little bit more about dental, and they want to see things in a particular way. Now, what does consolidated financials means? This is really more related to those that have more than one practice. So if you have practice A and on your P&L, you have dental supplies, lab fees, marketing, office, you got dues and subscriptions, whatever, go down the line. And then you have practice B, and it has different different line items or general ledger accounts that are labeled differently. That's going to be a problem, because what the bank wants to see on one P&L, and I'm going to get a little nerdy on you guys here for 1 second, I apologize. But it's called a P&L by class in the QuickBooks world. It's called P&L by class. And that's when you see, let's just take the month of March, because that you guys should have your March financials, but take the month of March, and you should see on your P&L practice A, practice B, and all the line items and expenses are the same across the board. Banks and other financial institutions that are looking to play in dental, that has now become a requisite before they start doing deals, because it's clear, it's transparent, everything's the same. They don't have to guess, are these proper are these proper data numbers, right? Is this all correct, right? And that's the biggest thing when it comes to consolidated financials. Did you want to add?
Yeah, I mean, I think the important thing to keep in mind here is, if you're a single practitioner and you have an inkling in your mind, okay, I'm thinking at one point I may add a second practice. I think the reason why we're emphasizing this so much is because we've seen this hamper deals or even prevent deals from happening, primarily for financing, for financing for growth, because with the hodgepodge of practices that are put together, because they're so individualized, or the chart of accounts aren't the same across the board for all the practices, and they're treated like individual business units. It will behoove you guys, as you're moving that direction, to look at consolidated financials as just to keep that in your mind. So if you're a single practitioner and you're like, I don't care about consolidated financials, at least put this in the back of your mind, because if you add that second practice, you immediately need to start thinking about consolidated financials, because if you're adding that second practice, there's a possibility of adding a third or creating those efficiencies. And to finance those efficiencies, instead of pulling it out of your own pocket, you should start thinking about, how am I going to finance my business? And we find that oftentimes that when we're working with clients, they're approaching their dental business as if it is a dental practice, and those get financed in the same way. And we have strategies, and we have worked with different financial groups, financing groups, that will finance in a way that is not your traditional way of financing. So when we're talking about consolidated financials, it may not be something that you're like, oh yeah, I gotta get on that right now, but it is definitely something to keep in mind and think about doing as you're moving to that second practice, or as you're adding that level of specialty. Because it could be that you're adding a particular part of specialty, but the way that you're working with that particular associate might be its own standalone business. And so therefore, you're going to find yourself in a situation where you need to have consolidated financials, because if you went and that went gangbusters and you're like, man, I got to open up a second practice and do this same model again, you're going to find yourself in a tough situation. Not a tough situation, but you'll find it more, it will appease the bank, and it'll make a much cleaner conversation to have those consolidated financials.
Awesome.
And then I think this is slide 3. So from here, are we doing a Q&A?
I think
there's that the net.
Yeah,
okay.
perfect.
Yep, we've got a built-in pause here for some Q&A, and we'll do some more at the end. So this isn't your only opportunity, to get a question in, but we do have a few questions that have come in from the chat and that are in the Q&A. I'm going to read those off to you guys now. You guys just feel free to jump on in and answer them. All right, first up, we've got what system do you prefer for accounting? QuickBooks with detailed dental chart of accounts?
Yeah, so I'll answer that. I love QuickBooks. It is simple. It is relatively cheap and affordable for practices. I've used different systems. Xero is another one. I could list off a couple others, but for me, it's QuickBooks, and it's well, I don't want to repeat myself, but it is easier. QuickBooks Online, to get even more specific, I prefer that over desktop. Desktop is great. The pros and cons, because I'm sure that's a question, right? Between desktop and online, is desktop is great. It's a little clunkier. It has a little bit of a more like 1990s vibe to it, if you will, but it's still great. It does give you more reporting. That being said, the reporting that it offers is, in my opinion, a bit too sophisticated than really like the dental needs.
It's more if you want to take deep dives.
Like it's just crazy, like reporting that, to be honest with you, even in my career, I've never even fully extended the amount of reporting that QuickBooks Desktop offers. Online, it's in the cloud. It's cheaper, right? Well, I don't know if it's cheap. Well, it's a monthly subscription, but what I meant to say was it gets updated in the cloud regularly from Intuit. So if there's any niche or any kinks, whatever, any new things they want to implement, it's updated regularly. It's in the cloud. That means that you don't have to be strapped into a desktop in your computer to access.
So accessibility is easier as far as getting access to the accounts for your accountants or bank or whatever it might be.
Correct. And because it's in the cloud, it has access to have other platforms tie into it. So if you want maybe Dentrix, and I actually don't even know, I don't think they have Dentrix, but Bill.com, for example, is something that people use to pay their invoices. That can get tied into a couple other things. But anyways,
Xero is also another.
Xero's great.
It's Xero. If you guys haven't, if you're not familiar with it.
Yep.
It's also similar to QuickBooks. It's robust in some ways and not as robust as QuickBooks Online. Sage is if you're doing if you're doing a large multi-practice group, Sage might have some deeper reporting and things that you might use. QuickBooks Online is definitely the easiest. It's the most intuitive.
I call it QuickBooks for dummies. Like seriously, not that you're dumb, but it's so simple. And I use it, and I've been doing accounting for 10 years. So I love it. Okay, let's hit like two more, maybe let's just do two more real fast, because I see some questions, and some of these we're going to actually touch on in our next segments.
Yeah.
Let's do this one. Let's see, that just changed. Let's see.
This one here.
Yeah, do that one. Will it be different accounting for an LLC treated as a sole proprietor versus an LLC with an S Corp election? Do you want to touch on that? I don't think it's much different. It's not different at all.
It will not be different. But I mean, this does kind of connect to the question down below, where it's asking about why are the shareholder distributions? I think maybe these are kind of connected. So why are long-term liability payments not on the P&L, i.e. shareholder distributions, loans, payments, etc.?
Yeah, this is actually a question that we get fairly often.
This is a great question, by the way.
It
gets into the nitty-gritty of like, how are you categorizing things and what's an asset and what's a liability.
Totally. And I'm going to try and just be kind of quick on this, because I know we have a couple other lines. Not to be nerdy, but I kind of have to be for a second. The P&L is where it's kind of where everyone kind of pumps their chest, right? This is our profitability. This is what's going on. It's really honestly where you get a pulse of your practice in terms of revenue and expense management. The balance sheet is tracking your assets, which is your bank account balances, accounts receivable. Should you be tracking that? Which I assume most of you guys probably are not at this point. And then liabilities, right? And any outstanding loans. And you mentioned long-term liabilities example. So you track loans, that's technically a liability that belongs on the balance sheet. Equity distributions is under equity, that is on the balance sheet. What you do see, it's just kind of the way that it is. It's an accounting way. It is, because what you're tracking on the balance sheet when it comes to long-term liability or any liabilities or any loan payments for that matter, you're tracking the principal, right? So you should be able to go in your balance sheet and say, oh, look, I have this loan with XYZ bank. Okay, what's my loan balance right now? Oh, it's $90,000, right? So you're tracking the principal and you're tracking the actual balance. On the P&L, however, you're tracking the interest. So again, apologize being a little nerdy. The P&L, you're tracking the interest payments. The balance sheet, you're tracking the actual like loan balance. And then for draws and distributions, it's the same thing. I mean, that's an equity to the owner. I mean, that is an owner's equity, is you're getting these distribution payments getting paid out to you, draws, for example. So to be honest with you, it's that aspect. It's a benefit to you as a practice owner to not have all of those on a P&L.
And this is something that takes a fair amount of effort and time, is to understand what shows up where on which financial sheets, right? Like, to understand, if we just go back to the loan aspect of it, if you think of the P&L, that's where you're going to show the chipping away at the debt. And where you see on the balance sheet, that's where you're actually going to see the total loan. And so that way you can kind of see, what did we chip away in this time period on the P&L, and what do we actually still have outstanding? And that's a great way to look at the overall health of the business.
Right. Cool. We love answering questions. So any other questions, you're after this, you're welcome to reach out to us directly, or actually, I think we'll have a link at the end as well to reach out to us after this. But yeah, we love answering questions. So
yeah, we're going to get through a few more questions at the end. We got another Q&A. We are right now just a little bit past halfway. We got through our first 3 of the 7 systems so far. So we've got the dental bookkeeping and accounting, just to recap in case anybody is late: simple, transparent monthly financials, consolidated financials. So we're going to keep moving forward, but again, we'll have another Q&A section at the end. So go ahead and jump in there and drop more questions in the Q&A. We'll get through as many as possible. But again, like we said, we're going to end on time for you guys today, respectful of everyone's time. But if you have any extra questions, of course, we'll make sure that those get to Austin and T, and they'll answer them for you guys afterwards as well.
That means we need to be quicker, T.
You picked up on a very subtle in between the lines note there, Austin. Nailed it.
We're long-winded. We get it.
I get it. I
Awesome.
get to go nerdy with it. You guys are doing great.
No, excellent. Thanks, Sarah. Budgets and benchmarks. Okay, so this is now the top tier, right? You have your accounting stuff in order. You feel confident on reviewing your financials. You feel like you're starting to understand them. Now what? Now what do you do with that information, right? And this is honestly where we excel. Like, this is why we created DSO CFO years ago, is for this very next this next section, so to speak. So budgets and benchmarks. Well, first of all, we know what budgets are, but what are benchmarks, right? So benchmarks, benchmarks are pretty much what is the industry standard, for example, for dental supplies. And we are going to touch on this in other sections, but right. So we know that through talking with several different large vendors like Shine, DDS Labs, for example, Patterson, we have our own clients. We have a lot of colleagues in the dental space, and we get an idea. We know that Dental Economics pumps stuff out on an annual basis. We're pumping stuff out on an annual basis, but it's because everyone's looking at their dental expenses on the P&L versus what they are bringing in versus revenue, right? So, for example, dental supplies, we know that typically it's 6% of your revenue is getting spent on dental supplies. Lab fees, 5%, payroll, 50%, marketing, 3%. I mean, I could go down the list on these things. So that's what a benchmark is, right? And we're gonna kind of correlate this back to your own practice. But a budget, let's say, for example, 6% is maybe a little too high for your practice. Maybe you want your dental supplies to be 5%, right? So let's say, for example, that you're bringing in $100,000 a month in gross revenue, and you want your dental supplies to be 5%, and maybe you want lab fees to be 4%, or maybe you want it higher, maybe you want it 7%. That's fine. It needs to be custom, and it needs to make sense, really. But
so just along with that, sorry to interrupt, but one thing that we always say in our onboarding meetings is we talk about your EBITDA. Where are you with your EBITDA or your net income? We can call it that. That's fine. Where are you at with your net income? For that percentage of whatever your net income is, that's what you take and put into your pocket, roughly, right? When you're looking at the benchmarks, when you're looking at the budgets, you get to the other side of the business, which is the expense management. And that's why this question is so important. Do they align with your goals? Are you getting after what you want to accomplish? And what's tracked and recorded has, I'll change the original quote because there's a quote around this, but I'll change the original quote. What's tracked and recorded has the possibility for improvement. And it's hard to be looking at your business and say, okay, I really want to be at 20% EBITDA because that's what I'm hearing at the conferences. So I want to get to 20% EBITDA. We're chasing for that. And it doesn't matter how much I keep working and how much more dentistry I make. I just can't get up to that 20%. And that's why we sit down in our meetings, in our onboarding meetings, and we say, okay, if let's say that you're at 15% EBITDA. So if you're making $1, you're taking 15 cents home. But if I can go back to your expense side and we can look at your budget and we can set those benchmarks or those expectations for your business of how you're going to improve. And over time, you can make those incremental changes or those incremental improvements. You can go from 15 to 16 to 17%. That's looking at your expenses and realizing if my expenses can go down by $1, that's $1 back into my pocket. And that, I think that's hard for a lot of us when we're running our business to really truly understand that, because we think growth and we think increased cash flow, we always think revenue side. And so we always think, okay, I got to run more Google ads, or I've got to get a front office that's answering the phones all the time. And yes, those are operational components that definitely need to be in there and can be improved. But a lot of times what's happening when you're setting these benchmarks and these budgets and putting those in place, you're allowing yourself to track and record for that improvement. And so putting that expense and saying, yeah, it's cool, I'm at 6%, and that's, 4 to 6%. If I'm in that realm, then I'm good to go. But if you went back to your business and said, my goal for my business is to grow so that I can add an operatory, and that's going to cost $75,000 minimum. And in order to get that $75,000, I've got to increase my EBITDA so I can pull that money out of the business, or qualify for financing because I've increased my profitability. Then those goals need to be put into your benchmarks,
right?
And you need to set those and track those so that you're moving to that direction. Right. I think we can cruise to the next.
Yeah, let's do the next one, Sarah. Thank you. All right, and then probably the next one after that. So on this, it's a perfect segue. Kpi, it's in line with benchmarks, which, and then your benchmarks kind of fold into your budgets ultimately, right? So Kpi, Key Performance Indicator, I'm sure we've all know what these are, or at least have heard of them. These are, and we're going to speak specifically to expense management, but these are key accounts. And this was a question that was asked on the Q&A. These are accounts that you're tracking regularly on your financials to know, am I keeping in line? Am I not? Right? So key performance indicators within dental. I think we've got one more slide, Sarah, too. Yeah, perfect. Thank you. Some of the key ones, of course, revenue. That's without question. But, and I've mentioned it a ton, but dental supplies, lab fees, marketing expenses, payroll expenses. You have professional fees, whether that's legal, you have an accounting, you have a consultant, whatever, right? And then you have interest, and then you have EBITDA, right? Those are probably the top 5 to 6, 7 KPIs. We don't like to make it more than that because it can get a little confusing, too much, a little bit overwhelming. But those are the primary KPIs that you should be tracking in your practice on a month-over-month basis. Now, I'm going to give you guys a little sneak peek, if you will, or I guess like an inside look as to what we do. I love looking at a P&L month over month for at least a trailing 12 months, or at a minimum 6 months, because I'm a huge believer of trends is everything. Because if you are looking at your expenses and they're going up, that means that you're trending up. That means that is a behavioral issue, right? That means that there's something going on where it might not be in line with your vision for your practice, or maybe a goal that you had set, right? Behavioral, I guess, but yeah, but behavioral decisions or habits are much harder to change than a unique one-time expense. I'm not really concerned about unique one-time expense, or maybe there was a unique activity, or maybe that you needed to build something out and you needed to do XYZ, over a space of 2 or 3 months. That's fine. But the trends is everything. And so when you look over month, you're seeing, are my supplies close to 6%, or maybe your goal is 7%. So whatever your goal is, right? Is it consistent with that? If it's not, then why? Is it trending down? Is it trending up? Is it the same? Whatever. But that's where the KPIs are so important, is because that is how you track the performance of your business and of your practice.
Yeah, and I think one thing to keep in mind, if you just look at the revenue side, right, at the monthly collection ratio of 98%, like that's just one KPI that you could that you could correlate to there, but your revenue, I mean, I think everyone that's here recognizes that revenue cycle management, if you just break it down to the very, very nitty gritty of it, money now is more valuable than money later.
Yeah.
And so it's amazing. And we've had several conversations with the eAssist team in person and online too. And it's been interesting. Every time we bring that up, they've mentioned to this. And in fact, when we were in a eAssist client as practices, it was consistent with that of how much bad debt we had sitting in that 90 day plus. And so when you're looking at a KPI and you're saying, I want my monthly collection ratio at 98%, and looking at what that means to the overall collection rate, these are all questions that are going to come out and that you guys should have as you're seeing, okay, I'm at 98%, that's good. But what does that mean as far as like how much of that slipped through is still there?
Right.
And what action is there that's accompanied to that? And I think the important thing about a KPI is, yes, it's important to track, but then you've got to go through and you say, if something's out of whack, or if we're doing well in this area, what is it that we're doing that's going well in this area? And how can that be applied to other areas? Or what improvements could we be making on top of that? So I think let's keep going.
Yeah, right. That's perfect. Thank you. And then here's just an example of some of the benchmarks and KPIs that are tracked. We don't track all of them. Like I said, we do keep our pulse on about 6 or 7, but this is our specific. So you're welcome. We're welcome to send this out to those that would like one.
Yep.
Okay. Strategic decisions for growth. So we're kind of going on this trend, I think, that we all kind of going towards. Now that you understand, you have goals, you understand what's going on. It's how do I now? One of the questions was you guys wanted to get an associate, or you're ready to be in a position to get some equipment, and that is growth, or get another practice.
Well, and traditionally, what we found in working with a lot of dentists, not just at his DSO CFO, but prior to that, often the answer was, well, I've got enough money. I got enough money. There's money in the bank account. Let's just put that operatory in because I know it's going to grow. That's not necessarily wrong, but with a strategic goal and a vision for your business, we want to make sure, and you should make sure that when you're making those decisions, what is the impact of you making that decision? So if you go to adding an operatory, let's say, and that rebuilds, you're going to go and have Shine or Patterson or whoever scope it all out for you, and you're going to get it, and it's $150,000 to do that. If you take that $150,000 and put it towards that, what is the opportunity cost of engaging that money? And what is the forecast going to look like if you add that operatory? And with a couple of questions, if you just sat down and answered a couple of questions to yourself, you could write it down on a notepad and say, okay, how much money am I going to make per month in this operatory? And that's finding the answers to these questions is relatively simple, but it should be something that you cycle through when you're making that decision. And oftentimes we're like so quick about stuff. We're just like, okay, well, I know I need another operatory. Let's just build out our operatory.
Right.
And what we're seeing is making these kind of like shoot from the hip decisions are causing cash drain on the business.
Correct.
Same thing with financing. We didn't really address that here, but when you're financing equipment, especially when it's needed equipment, oftentimes we say, well, the business can bear that. I've gotten a rough financial estimate from the equipment company or from the bank or whatever, and they're saying that I can bear this debt, and it seems reasonable. The problem with doing it just that way is that it doesn't encounter the vision of what you're trying to accomplish with your business. Where are you trying to go? What are you trying to get to? And making sure that when you're looking at it from that financial lens, can this make sense, and make sure I'm taking home what covering all my expenses, making sure the business is healthy, and then taking home what I want to take home. Is that going to be hampered by this financial decision that I think is needed? Or is it something that I wait on? Or do I need to look at a different way to finance it? Or is there a more strategic way that lends to the vision of the business?
Well, real fast, and before we go to the next slide, is one thing that that I'm not saying you should do it, whether you have the skill set or not to do it, but one thing that we do that we like doing for those for our clients really, but we like forecasting and modeling out scenarios. So if you want to get that additional associate, for example, okay, great. What are they expected to do in revenue? Okay, great. What is the suggested salary? Okay, great. What are the additional expenses that we think? And this is all estimate, right? I mean, we don't know for sure, but no one knows the future. But if you have realistic expectations for expenses and revenue, then you can start to model out and get an idea on paper, right? Because you don't know what it's going to look like. But if everything goes according to plan, you at least see what it looks like in the future on paper, right? And so, that's something that we do for our clients, that when they say, yeah, we do want to get that different, we do want to build out that additional opportunity. Yeah, we do want to get that that associate. Can we do it? We say, okay, great. Let's just take a look. Let's forecast out months in advance, plug all these scenarios in, and then see what that would look like, right? And then, if it looks good and it makes sense on paper from a cash flowing standpoint, then that's a suggestion that we make, and we say, yeah, it makes sense. This is reasonable. Or you might want to wait until these things kind of kick in, based on your decisions, for this to take place.
And it doesn't take the ability to make a quick decision away. What it does is it always starts your decision with that financial lens.
Right.
And if you're making a decision based on the financial lens, theoretically, and what we've seen time and time again, is you end up making a better decision for the business.
Right.
And which should be a paramount, right? Like if that is your decision-making process, because it aligns with your vision, and your vision could be, I want to step away from the chair for a couple of days because my time is better used in doing this other function or this other thing, or I'm developing this, or I'm doing whatever that might be. We just need to figure out what that forecast looks like of when that could make sense, and then make sure that is being tracked on
Correct.
whether you're attaining it or not.
Correct. So that brings us to the next slide. And this is, I believe, our final slide here before the Q&A. So monthly financial review, it's kind of wrapping everything together and coming to a head, right? These are great, but are you meeting with your bookkeeper and reviewing your financials on a monthly or regular basis? If you are, great. Are you understanding what's going on? Do you have questions? Are you actually dedicating the time to walk through those things? If not, what is keeping you from doing that? Do you feel like there's no value? Do you feel like you're not getting confidence in your financials? Is it too overwhelming, right? These are questions that you need to ask because there's value. There's value in looking at your financials and knowing, where does your business, where does your practice stand? Where can we increase? Where can we decrease, right? Where are our weaknesses and our strengths, right? And look, there's going to come a time that either you're going to want to sell your practice, you're going to want to bring on a partner, an associate, you're going to want to get a loan, that people are going to want to know what's going on in your practice. And then you can confidently say, this is what's happening, right? And you can be transparent. You can say, hey, another associate, we're bringing you on because we need help here, right? And then you can form a proper, true relationship, because now that person knows exactly what they're taking on.
Yeah, and so I mean, obviously, we would love for everyone to be doing monthly reviews with us, because that's what we are passionate about, and we love doing it, and we like helping people grow and build their businesses. That's what we like doing. But just from let's make this incredibly practical and pragmatic for just a second. Okay. I'm assuming everybody on this call is getting a P&L on a regular basis, whether that's actually every month or not. But let's just assume everybody's getting monthly financial statements. Here is what I would say to everybody on this webinar. Take a little bit extra time, whether you review that with someone else or not. Let's just pretend you only review it by yourself. Take the time to go through your P&L and say, what do I understand, and as far as what's something on here that I know I understand and I know we can do better, right? It's not just I'm not saying that you guys might not understand the financial statements. That's not what I'm saying. Just say, here's something that I really truly understand as a cost center, and I know we can do better. And that could be on the revenue side, but I'm just going to be specifically looking at the expenses. I would challenge you guys to go back to your financial monthly review, spend a little bit extra time and go into your P&L and say, what is it that I can do better, even by 10%?
And do it on a month, again, a month over month, because now you're seeing this month we were high, this month we were low, this month we were low, this month we were, right? You can understand what's really taking place, because if you're looking at just 1 month, maybe that's it. That month has an anomaly to it, right? So just it opens up your understanding dramatically.
But just pay attention to one thing, one or two things, and just say, okay, I'm going to look at this for a trend. And that's a great place to start. And it might not be that you're looking at like a fractional CFO right now, or that you need to get a level, or you're like, you know what, I just need to understand my financials better and I want to focus on that. This is a great place to start, right? Look at your trend and what you can make better and just work on that for a little bit. And those incremental improvements, you're going to see that reflected on your financials. It might not be tomorrow, but as you trend on that and focus on that, those things can have the possibility for improvement.
Awesome.
Well, I think that was certainly more than just one nugget. Hopefully everybody's leaving with several nuggets between those 7 systems you guys have just outlined. I do want to take a second and just remind you guys how this all kind of connects. Most of you guys on this call are already eAssist dental billing customers. That's the majority of our customers. If you are not already, of course, that is incredibly important to make sure you're collecting 100% of what you're rightfully owed. This is what Austin and T were talking about a few slides ago when they're talking about your collection rate, right? Getting it to that 98%. Getting it to that 98% is incredibly important. Collecting 100% of what you're rightfully owed from insurance companies or from your patients. Really important that you guys have that as one of your 3 things that here I kind of called the financial peace of mind trifecta, which I understand is a little bit of a cheesy name, but I swear it's just so accurate. These are the things that we hope every dental practice can really have in place. And of course, eAssist also offers deposit reconciliation, which is part of our dental accounting and bookkeeping service. So that allows you to ensure that what you actually collect from the insurance company and from your patients, that actually makes it into your bank account, right? Nothing's going missing, no funny business. And then the last piece here that is so critical, it's really what's going to secure that future. It's the future of your practice, right? And that's strategic support from a fractional CFO, which is our friends here, Austin and T, and their incredible team at DSO CFO. But getting that support so that you have the forecasting to help you achieve your goals. Again, like they said, whether that's adding an associate, whether that's adding a hygienist, whether it's taking a couple days away from the chair, being able to think about your life and do other things. These are goals that you need to plan for financially, and you need a CFO, a fractional CFO, to be able to support you guys getting there. So this is kind of wanted to connect those dots here so you guys understand how all of this kind of flows together and why we feel so passionately about the DSO CFO team and the service that they offer here. And so before we move any further, I want to make sure you guys know that you can schedule a consult. And so in fact, somebody asked in the questions right here, how do we get more information, get more personalized guidance on these kinds of matters? Please pull out your phone right now, scan this with your camera app, and you will be able to book a consult. When you book that consult, you'll be able to talk to our eAssist team as well as our DSO CFO team. We'll book 2 consults. If you book one, we will book one with our eAssist team and one with our DSO CFO team for you. So all you have to do is fill out that Calendly link one time. Our team on the back end will make sure you're booked with DSO CFO as well as eAssist. Again, that'll give you the opportunity to review and make sure you guys are set up for this peace of mind trifecta, being able to accomplish the goals, really the practice of your dreams, the financial goals of your dream practice there. All right, we are again going to email this out to you guys. You guys are getting the slides in the recording. This does leave us just shy of 5 minutes for some more Q&A. We got plenty of questions to get through, so I hope we can fly through them pretty quickly here for you guys. But if there are any we don't get to, we will make sure to send them to Austin and T, and we'll try to follow up with you guys afterwards via email and make sure we get to them.
Awesome, thanks. I think there's a few that we can answer super quickly. We'll be vague.
What about that one right there?
We talked about that one. The 3 lines that you should pay attention to. It's custom, but expense management again, dental supplies, lab fees, and I would say payroll 50%. And then someone asked, is the doctor wages included in that? Yes, the doctor wages is included. Associate wages are included in payroll. That's incredibly important.
And then someone asked a question about the QBO essentials. It does not do budgets and forecasts in the essentials. I think they're very basic.
Yeah. So, but hold on though. Yeah, there's certain reporting. There's different platforms in QuickBooks Online. We love this tool. It's called Budget to Actuals. We actually use it for forecast to actuals because we want to see if you're lining up and you're hitting your goals on your forecast, which again could be your budget. There's some platforms that don't. I don't know if Essentials does or not. It doesn't matter what you have, because what we do is we take your P&L and we customize it on Excel spreadsheets anyways.
Well, and then there's this other question about, can Dentrix be interfaced with QuickBooks Online? It cannot.
Not right now.
No, and so then
I
that's
wish it
where you
did.
would need a reconciliation like what was offered here.
Yeah, so that's what eAssist is really good at, doing the deposit reconciliations. So that otherwise it'd be incredible. The dental industry average for EBITDA is about 15%. 15% is pretty good. You're hearing people pump their chest on 20%. That's incredible. But 15% is the industry standard. And it's a great return, frankly. Okay. I think we tackled the doctor. I think we have 2 more minutes.
When we introduce.
Yeah, so we talked on this. What is the industry average for payroll as a percent of gross collection? You only showed it should be 50. Look, when it comes to payroll, it's hard. Look, we say 50%, but if it's 55%, cool, you're in the range. If it's 57, that's okay. It's just like, what's happening, right? What's happening in your practice?
It's a global conversation about what's happening with the business.
Exactly. So it's yeah, we say 50, we say 6% on. Hey guys, Austin and T here from DSO CFO. We wanted to make sure that we got to all these questions. We're very big on trying to answer all questions that everyone might have. If you have any after this, please feel free to reach out to us. Okay, so we got through some, but we wanted to make sure that we got through all of these.
And there was one question that we kind of glossed over, but we did address, and Sarah also talked about. As far as getting personalized guidance in these matters, there's the Calendly invite that you guys can go, the QR code, and then you can also contact Sarah directly about getting together with us. And I think she's linked to our Calendly.
Yeah, and if you want to learn more too, before that, you can always visit our website. We have information there as well, just on us.
Which is just dsocfo.com.
Correct. Thank you. Okay. So I think we tackled some of these here, but the next one is we talked about the QuickBooks Essentials. The dental industry averaged 15%. We talked on that.
Yep. And the payroll does include the doctor.
Correct. So next question is, when we enter invoices into QuickBooks, how is the best way to quickly look into the KPI percentages of expenses? Is there an easy way to extract this transactional data into Excel so that we can set up formulas that easily calculate this each month? So
you can export it as an Excel file if you wanted to massage it and then build your own formulas. That's pretty straightforward.
Yeah, you can do that. But in terms of a KPI, because now you're going off of revenue, so you need to have your QuickBooks. So you go into your bank feeds of QuickBooks. Again, apologize for getting nerdy on you here, but into the details. You go into your bank feeds. All your transactions have to be in, and all your revenue and income and deposits and all that, they have to be in, right? When you have no more transactions, let's say it's the 18th, or what is it today? It's the 29th or the 28th of April. The month isn't done yet. You still have pending transactions taking place. If you get everything in right now, you can go to your P&L and you can look. You can look at your P&L whenever you want to. It's just a matter of, is it accurate? Do you have everything in there? Bank accounts haven't been reconciled, so there's a plus and minus whether or not it's 100% accurate. But you can do that, and there is a way to look at just your P&L with percentages. I think it's just called P&L percent to income is what it is in QuickBooks, and then it has your accounts, has your revenue and expenses, and then right next to it has your percentages, and then you can just look right there. It's very easy. So that's a little snippet.
Well, and I think you're bringing up an excellent point. One thing that we like to look at is we're going to look at financials the same day every month, right? So
Correct.
we're going to go to the 20th of the month because we know that everything will be accurate at that point. So
Correct.
I think this might be a little bit deeper of a question than what you had the chance to write out here, but like as a percentage of expenses to see it almost immediately, it might not be exactly the picture that you need to be reviewing. You might want to just wait until the same time period to review it once a month. So let's jump down to this other one. There was one that they were concerned whether they were distracted, whether they missed something or not. What is the formula for computing collection ratio? This is essentially just how much has actually been collected it's basically your net collections versus your collections. So you could have collected, let's say, $100,000 for the month, but only $98,000 of it was identified. So you actually deposited $98,000 into the bank account. You may have charged for 100%.
Correct.
But you may have only collected 98. So it would be the difference between I'm saying the wrong term, but you would essentially be the difference between what you have collected in your PMS versus what's actually hit your bank account.
Correct.
The other thing is this one is here. Is there a metric for evaluating if a hygienist pay is appropriate versus their production or collections? It is not as simple of just having a metric. It has a lot to do with the goals of your business. That'd be really hard to just say this is the definition of whether it's appropriate or not. Traditionally, you want to get 3x. If we make it super basic, you want to get 3 or 4 times what you're paying your hygienist. Whether you pay them on a daily or you pay them on an hourly, you would essentially want to look for the day and say like, okay, I'm paying $300 for the day. I'm hoping to get over $1,100 or $1,200 for that hygienist. That's a really broad general rule. But that's a safe way. Honestly, whoever asked this question or anybody else who's interested in this question, this probably merits a couple questions on our side to figure out what you're doing with your hygiene department, because it could depend on a lot of factors. But roughly, if you're just looking for a rough 3 to 4 times what you're paying your hygienist.
Real fast, there's a bunch of questions on payroll. We can go into the nitty gritty on payroll. It's not exact. Again, it goes down to your practice, what you want, what collection rate that you're that you guys are doing for your hygienists and your associates. That being said, 50%, we did touch on this, 50% is the goal. You can go over, you can go under, but it's roughly that role, and it's good to track on a regular basis. Okay, and the last question that I see that we didn't really touch on, if you have others, please, again, you're welcome to reach out to the ESIS team. We love answering questions, but it was AR. So yeah, you did touch on this earlier, but if Dentrix can be interfaced with QuickBooks Online, said that your cash basis, so no AR. Let me just touch on real fast on cash basis and accounts receivable, because this is a kind of a hot topic in Dento right now. Typically, if you're under $10 million in revenue on an annual basis, you'll want to stay cash, and it really comes down to simplicity of your books. Accounts receivable, accrual method, it's more appealing for banks, for other financial institutions, but as you get higher and higher in the revenue, they're going to want to see more of an accrual. And the difference is cash is what happens when money hits your account or when it leaves your account. It's that simple. That's it. Accrual is, for example, and the easiest way I can explain this is, let's say that you get an invoice for supplies or from someone, maybe you have a contractor coming in and doing some clinical work, right? But you get invoiced that on April 28th, but you actually don't receive that invoice until maybe like May 11th, right? Or maybe you don't end up paying that invoice till like May 11th or May 15th. You're gonna show the work that is done in a period, right? So that person came in, they did that work in the month of April. Therefore, this is what took place in April, despite you either paying them out in that month or not. And then it really gives you a really good idea on trends with accrual, because it's showing the proper activities taking place in each month. In order to go accrual, it sounds appealing. It is, frankly, it is. And most, like I said, most banks and financial institutions prefer accrual. That being said, you have to be in a position to go accrual, meaning, are you tracking accounts receivable? How are you doing that? Is it consistent? Right? And then you just have to have a team ready to do that. And we've noticed that when teams are not prepared, don't have the man hours or the time to get all this data, to get all these operational exercises or routines or what have you in place, then it's going to be a struggle to get financials on time and accurate, frankly. So yeah, and I think that's it in terms of questions. For now, again, we love questions. We hope to do this again with eAssist. We had a blast. We look forward to receiving questions or hearing from anyone.
If we didn't answer your question, or we didn't get exactly what to the basis of what you were trying, or the core of what you were trying to ask, just contact us. Let us know.
Awesome. All right. Thanks, guys.
Thanks, everyone.